So without a doubt, there is a renewed sense of optimism, I would say, in both the masses, mainstream media about the property market and the economy as a whole. In fact, I was up in Chester just doing my 2-weekly pilgrimage up there for 5 days, speaking to my builder, who said that he has never seen such a load of inquiries for new work come in January. It's been his biggest January for many years. And to me, that's an indication that people feel things are turning and maybe we've bottomed out. But what I want to talk about in this video is how the graph that I got up here actually maybe paints a different story to where a lot of people think we are in the property markets. I'm going to talk through this graph, and I'm also going to look at the data that's come out over the last few days since I last went live to see where we are in many aspects before we go for the latest inflation figures that are out on Wednesday. Of course, that's going to create a lot of discussion points, and really for me is going to dictate the trend. Have we actually seen inflation drop off properly with a confirmed trend? And if we have a third large drop off in a row, that will be for me a confirmed trend. Or is it 2 one-offs and then we're going to go into stickiness? So we're going to crunch the data. We're going to get into that in a second. But first of all, I want to give you a quick message. For those of you who are regulars, you'll know that I'm fascinated by data. And when I look at the channel stats, I can see that just under 65% of people who watch my videos aren't actually subscribed to the channel. Now, I do know this stat is actually way above the average for YouTube and shows the power of the community that we're building here. But I want to do better and I'd like to make a deal with you. I've got a vision to empower as many people as possible on this planet to take ownership of their futures using income producing assets to reclaim your time, freedom and choice. And if you can just hit that subscribe button, I'll work tirelessly to grow this channel, make it better and better for you so we can fulfill that vision together. I cannot tell you how much it helps. As the channel gets bigger, I can put more resources behind it, improve the production, the content, and ultimately the value that I give to you. So if you could do me that small favor and hit that subscribe button now, as well as the like button on this video, it would mean so much to me as we continue to grow this community together. It's the only favor I'll ever ask you. Thank you, and let's get back to the episode. Okay, so please do hit that subscribe button now and also hit the like button and find the comments button if you're on the live and you're following through on the live. And if you're on the replay, feel free to follow through like you're on the live, ask your questions. What I generally do is go through the figures and the facts and then come and we can have a discussion afterwards. And for those of you who are new to the channel on these live streams, what I aim to do is cut through the mainstream media BS, some of the headlines that are out there and try and look at what's actually going on. So I want to focus on this. Now, this is the real or inflation adjusted house price index that's published from Nationwide. So effectively, it's a nationwide HPI and then adjusted for inflation. Now, if we look at this graph, there's something that for me is fairly obvious. And that is that the correction in real house prices has been extremely dramatic compared to the nominal house price falls, which are the ticket price of a house. So a lot of people have been talking about where is the housing price, the house crash gone? Is it going to happen? We have seen it. We've seen significant drop of real time value. Now I get it. A lot of people say to me, Rob, don't care about inflation adjusted house prices or real house prices because we buy and sell houses in nominal terms. And that's correct. I get it. For the majority of people, I talk about this in terms or from the perspective of being an investor / developer, i.e. a property entrepreneur who makes money from property, and therefore understanding the inherent value of that asset is important. And right now I look at this and property has gone down a lot in terms of real prices. Obviously, we've seen inflation be high, and that is very important because right now I'm looking at that going, that is cheap. Property is cheap in terms of inflation adjusted or real prices. Of course, when you compare it to wages and the price of everything else, it's now become a lot cheaper. And let's just see how much cheaper. So if we look at this, and I crunched these numbers just before coming on, we're actually 22% down from the very highest inflation adjusted house price. Just to show you where that is, that's Q3 2007. So let me just actually, if I go on to drawing tool, that's here. Okay, so that's the very peak. So we are 22% down to where we were there. And if we look at the current cycle, okay, so the current cycle peaked out in inflation adjusted house prices at Q1 2022 with 15.7% down. So again, if we look from there to there, that drop is 15.7% down in what's that, sort of a year and a half. That's quite a large drop in a year and a half, okay? So we have seen that price crash. So when everybody's wondering, why are the house prices not crashing? And I talked about, last week I did sort of 10 to 11 points of why they haven't crashed in nominal terms, but I ended that by saying, look, in real terms, we have seen a significant price adjustment in the property market. And that's important to understand if you are looking to effectively make money from property as a professional, as a property entrepreneur. So that's the first thing that I wanted to talk about. The next thing I want to talk about is we've seen the Rightmove HPI, House Price Index, come out today. And of course, the headlines are all about house prices are on the up again. So let's look at the actual data and let's understand what's happening with the Rightmove HPI. Because sentiment, I believe, is such an important part of what's going on here. Okay, markets are shifted by sentiment, and of course we've got two separate things. We've got affordability and we've got sentiment. Everybody, the perma bears, the people are saying we're going to be crashing this year, still 20-30% are saying affordability is the constraining factor, and that's going to drag things down. But sentiment, and we talked about some of the reasons why nominal house prices haven't crashed, and therefore what people can do to effectively stretch their affordability much more, including having more liquidity or borrowing more deposit from potentially Bank of Mum and Dad or excess savings or whatever they've got out of excess liquidity from COVID, by spreading mortgage terms from 25 years to 30, 35, 40 years. All of those things are effectively stretching out our affordability, and also nominal house price growth, as well as geographically relocating. So going from some areas of the country, which are more expensive, to other areas where we're getting more value. Okay, so there's lots of factors that have been going into propping up those nominal house prices. Of course, inflation has hidden a lot of those crashes. So mainstream media is starting to look quite bullish on property prices. Of course, we love in the UK our property. We love thinking that property is a store of wealth, and therefore if we own a house, if it's a home, that is one of the biggest stores of wealth we have. By the way, that is exactly why it's so important to understand this, because if you view your property or your home that you live in as a store of wealth, but actually it's going down in intrinsic real value considerably, then it's not such a great store of wealth, especially if you're paying money for, interest, a lot more interest if you spread the terms out, maintenance, all of that sort of stuff, right? It's not quite the asset you might feel it is, even though it's going up in nominal terms. So let's look at the Rightmove HPI. Here is the zoomed out. So whenever we see those headlines and people talking about property price jumps, and don't forget, both Nationwide and Halifax House Price Index at the beginning of January also reported in excess of 1% month-on-month rises. Okay, so the Rightmove, and let's just go to the actual headline. So we've got a tentatively promising new start as buyer and seller activity jump. Okay, so that's activity. The one that I saw in the mainstream was talking about the amount, so it's something like £5,500 worth of price increase on the headline rate of the Rightmove HPI. But we have to understand, before I look at the trends, okay, and go into this graph, we have to understand what this index is and what we are talking about. So this is completely different methodology, a completely different model to both the Nationwide, the ONS, and the Halifax, which are all hedonic regression models. This is actually just an average price of the listings that go onto Rightmove. And it's the average price of the listings in the month that they're listed. So it's not capturing subsequent price drops. So when the headlines say 5,500 or property prices jump by 5,500, no, it's the average listing price on Rightmove in January or December or wherever we're looking at is January, have jumped by £5,500. Now, because it is average rather than a hedonic regression model, this can just mean that the properties that are being listed are a lot more expensive, right? So it could be that a lot more higher value properties in the south of England, when we look at regional variations, there's some evidence of that are coming on the market, and that is skewing it up. Also, when we zoom out and look at this, yes, we've had a little jump, but we're still a long way below the peak in terms of average asking price. Okay, so yes, a jump, but 1 month is not a trend. We need to understand the trends and look at that big picture. And big picture, we are still in a downtrend channel there in terms of asking prices. I would comment, however, that because of that perception and because of where people maybe perceive we're going in 2024, it does feel to me, just looking at the various data points, that we're having an unfreezing of the market, and that sort of buyer or seller activity is increasing. People are now thinking there's going to be more buoyancy in the market, and therefore maybe not sitting on their hands anymore and placing their properties on the market. Or it could be that people are sitting on their cheap fixed rate debt. And every month you get more people coming off the cheap fixed rate debt. Those mortgages are expiring and they're refixing. You're like, right, we've got as much as we can out of this cheap fixed rate debt. We're now on a variable rate, or we've had to refix on a higher. Now's the time to sell, okay? Because we're off. We don't have that mortgage anymore. Now, when we look at this, okay, we can see that the average stock per agent has actually been coming down since the peak was sort of September and October. We have average of 54 properties per agent. That's come down, which means there is buying that's going on, or a complete lack of flow of supply going on. However, this is now looking at December, so we're looking at rear view mirror here. We're looking at lag metrics rather than lead metrics. This is a lead metric, okay? 5-year asking price trend is a lead metric. Average stock per agent is a lag metric, so it's something that's already happened. So the reasons behind that could already be gone, okay? Another lag metric, but a really interesting one, and this for me is probably the biggest one that I sort of opened my eyes and looked at, and that's the average time to secure a buyer. And we can see a pretty much an uptrend from March, where it's stable, and then August onwards, okay, it's getting bigger and bigger and bigger, or longer and longer and longer in terms of average time to secure a buyer. So that for me means, number one, that we haven't had a lot of buyer activity out there. Okay, so as we know, and we're just recovering sort of data that backs up what we've been talking about for the last however many months, there's a big lack of liquidity in the market. When I say liquidity, I don't mean money, I just mean transactional liquidity in the market. There aren't a lot of buyers out there buying, and that's getting worse and worse, which probably means sellers are still not quite being realistic in how they want to sell things. So those are the large things I want to take out of the Rightmove HPI. Okay, so let's not get too fussed about 1 month up. And I say the same when we have months down. When we have down months, we can't get too fussed about down months either. We have to look at that big trend. Okay, and the big trend is still a downward channel from sort of peak of May, end of spring, beginning of summer 2023. And actually, when you look at this, you can see that the uptick we've just had in January, which is always going to have an uptick, you know, post Christmas, people are going to go, now's the time to list. It's still less than what we dropped in December. Okay, so we're still sort of lower now than we were in November 2023. So that's Rightmove. I don't want to spend any more time on Rightmove. I do want to spend some time, and Gordon, I can see some comments coming in. Team, as we go through, please put your comments in. I'll come and have a chat afterwards. Rightmove, be careful of the data, or be careful of the headlines, because of the type of model and because of the big picture view. We have to take that with a pinch of salt. So, in fact, sorry, something that I was going to talk about and just point out before I move off Rightmove, and I think this is quite pertinent, is when we look at the regional trends. Okay, we can see that the biggest, I don't know if you can see that, I don't know if I can zoom in on this, there we go. The largest jump in terms of month on month by a country mile is the Southeast, right? We've got a 2.4% month on month increase there in terms of listing price. Now, that of course is going to skew. London negative 0.4, East of England 0.4, well, we've got East Midlands 1.2, we've actually got a negative in Yorks and Humber, we've got sort of a 0.6. In the northeast, and then on the west side, northwest 1.2, 0.4, 1.1, 0.5. Is that giving us an average? Let's see if they give us an average. The average is 1.3%. Okay, so the average across the UK is 1.3%. But I'd imagine a fair amount of that is skewed by the southeast figure of 2.4%. So this for me fits the narrative, knowing how the Rightmove index works with average listing price, that we're probably seeing more and higher value properties in the south be listed at the moment, which to me probably means, as I said, one or two things. Either sellers are coming off the cheap fixed rate and now they need to get rid of it, or there's some, they've been sitting on the hands for a while and they're like, look, we see some positivity, now's the time to test the market after Christmas. As we go into spring, right, which is always the most buoyant sort of time for sales in the year. If you look at the whole year, we always have that sort of spring increase. So people are probably going to go, now is the time to get listed because there's some positivity going into the market. So there we go. That's Rightmove. What I'd like to talk about is the affordability as well, because I think it's an interesting thing. Now, look, my view has always been we are in for a longer, shallower correction in property prices. I've said that since I started this channel, that rather than that crash, I've never said I see a crash coming. Looking at all the big picture metrics that we've got, I've always said it's going to be longer, shallower. Doesn't mean peak to trough is not going to be it's not going to be as deep, but it's just going to take a lot longer to get there. And I still think the same in 2024 for the moment in terms of house prices, i.e. maybe very slight nominal reductions in 2024. But at the moment, we're seeing a lot of metrics reverse and change. So we're seeing, again, this push-pull. I think it's fascinating where we are on the market, that actually a lot of the leading indicators are now suggesting that house prices would start to go up again. but we have some contrarian leading indicators. So leading indicators in terms of affordability. Let's just talk about that now, because affordability is a leading indicator. Unemployment or employment is a leading indicator. Clearly, if employment starts to fall, unemployment goes up. That's going to have an impact later down the line. So these are the things that we're looking at. And another thing that's a leading indicator is the economy. Right, for me is GDP. If we start to go into recession, again, that's a leading indicator that it's going to knock on to the property market in the future. So although GDP readout is a lag indicator, for me it's a leading indicator of what can happen to the market. So we need to understand what's going on with the economy. We need to understand what's going on with unemployment. Of course, those two are intrinsically linked. And we need to understand what's going on with affordability. So let's talk about affordability, which feels like it might be easing for certain demographics. Now, whenever we talk about these sort of stats and figures, it's very difficult to go into every single sort of percentile or 10 percentile of the UK population, because of course different percentiles and different demographics are going to be affected very differently. We are generally not talking about probably the top 10, 20%, maybe let's say top 10%. We're probably not talking about the bottom 10%. We're probably talking about sort of the 80% in the middle. For a lot of the middle, I would suggest that affordability appears to be starting to ease, especially if we have inflation genuinely coming down, but we'll wait to see what happens on Wednesday. Energy has certainly come down from where it was a year ago, and the price cap, we're actually seeing forecasts of the price cap come down fairly significantly over the next couple of quarters, and we're not seeing a lot else feed into the system right now. So a lot of the inflation, even though it was there for 18 months, 2 years, maybe we can now say, right, it was transitory inflation. It was there for 18 months, 2 years. Third-party shock, transitory inflation. Okay, that's short, sharp, but was always going to resolve itself regardless of what happened to interest rates. Now, of course, on the other side of this, we've got interest rates, right? And how is that weighing down on the economy? So let's talk about affordability and let's look at where we are with mortgages for home buyers. Now, this is home buyers. So if we look sort of at this peak here, which was that sort of August 23. So summer last year, if you remember, we had mini budget disaster created a massive surge in the swap rates and a surge in mortgage rates, which then came down. But then we had the sticky inflation, which really hit us in the summer of last year. And this is the point we're going, okay, here we go, right? We now got massive affordability issues. Interest rates were forecast to maybe hit 6.5%, even 7%. I remember there were analysts from major global institutions talking about potential of 7% by the end of 2023. However, this has not materialized, right? And we're now seeing, and I don't want to go into the legitimacy of CPI numbers right now. We'll talk about that on Wednesday when the next print comes out. But let's just take for read that CPI has come down twice with large jumps, much bigger drops than people thought was going to happen. And now we've seen the mortgage rates or the swap rates follow suit because the markets are betting that interest rates and central bank interest rates are going to come down sooner and quicker than the central banks are saying, and the mortgages are followed. So we can see a continued downtrend of mortgages. And even look at this, right? So look at this 60% loan to value 2-year fix has actually accelerated into January, that drop down. And we're all the way back down to where we were sort of, spring last year, and we're still coming down, which is surprising. It's still coming down, given the fact that interest rates are still at 5.25%. If the swap rates are continuing to come down, and the mortgage rates are continuing to come down. And yes, we've got two factors at play. One, the swap rates. Second is the banks competing against each other. So we have to take mortgage interest rates, and the reason they're dropping so dramatically with a slight pinch of salt, there's heavy competition in the market because of lack of buyers or borrowers in the market. But it doesn't matter. The mortgage rates are coming down. So people who are now coming off their cheap fixed rate debt are able to fix in to rates that are well below where they were 6 months ago. And that is going to affect affordability or increase affordability for those who've got the mortgages. So are we through the worst of it? Right now, the data suggests we are, with the trends going down. Doesn't mean that won't change, by the way. Doesn't mean that won't change. So that's mortgage rates. That's the first thing that I wanted to look at. This is positive news for house prices because it increases affordability. The next thing I want to look at is the UK Composite PMI, Purchase Managers Index. And again, the last set of data for December 2023, right, has shown a continued uptrend. And if I go on to, let's just go on to the chart here, just to give, if nobody's seen the PMI before, it is almost a litmus test, if you like, for how the economy is doing. And this is based on a survey of purchase managers, so supply chain managers who are seeing, what's being procured, what's coming in, and therefore it's a good understanding of the economy, or a forward-looking indicator of the economy. We can see after quite a big drop down, we're now on a trend back up, which means confidence is returning in the economy, which is interesting. Anything above 50, I don't know if you can see that. You probably can't see that. This line here is 50. Anything above 50, we are effectively expanding. Anything below 50, we're contracting. So we've seen 3 concurrent increases in the PMI, which means confidence is improving there. Let's look at GDP, right? GDP is still ping-ponging around all over the place with no confirmed trend. Well, the confirmed trend is flatline, right? After seeing the drop, quite a substantial drop of 0.3% in October, we've rebounded and taken it all back in November, which seems to be the pattern of things, that every time it looks like it's capitulating and going into recession, a month pops in where it's looking good again. Now, we have to question this, because don't forget, previous months have been revised down. Very important to understand that we've seen this, and then this data gets revised as more data comes in, been revised down. So is this another case of the initial data coming in to show that we're going to avoid recession in Q4 2023? And by the way, we've had a 0.29% dip in October. We've had a 0.31% increase, which probably puts us pretty level. If I take the individual elements out and just have a look at the graph, those are pretty much wiped each other out. So December is going to be a big one. Do we see a December bounce, right? But again, let's just think logically through it. If affordability is increasing, right? If people's wages are going up, if mortgages are coming down, if energy price cap is coming down, does that give people more affordability to go out and spend more stuff? And is that actually going to start to have a contrarian or conflicting push-pull with the interest rates going on? So that's another question that we're going to have to ask, not today, but I just want to throw some things out at you today. There's a lot of data to catch up because I've been away for 5 days. What I would like to do actually is just show you this for construction, because we are talking about this mainly for property, the property market. This is a property channel. If we look at construction, property market is inherently linked to construction, of course, house building, all that sort of stuff. The construction industry is not looking good. This is not looking healthy at all, in the slightest. I spoke over the weekend, and this is anecdotal, of course, to a friend of mine who's a property developer. They do sort of, I would say, medium-sized sites, so anything from, I don't know, sort of 7 to 10 properties to 30, 40 property sites. And he said they're really struggling to find any sites at the moment that actually work in terms of a figures point of view. But they have to keep pushing forward. They have to keep buying sites because they've got lads. If you lose all your lads, then you're never going to get them back. They're going to go and work for somebody else. So you've got to keep the machine ticking. So a lot of these companies are buying land over the odds just to keep churning out stuff, even though they're not making a huge amount of profit. And a lot of that is due to the cost of labor and the cost of materials right now. And if you look, cost of labor has gone up, cost of materials have gone up, house prices have come down. So that margin for a developer has gone smaller. There's not a lot of margin in it anymore, especially as a lot of land bankers, landowners are, only wanting to sell their land for probably more than it's worth. So it's a challenging place. And this is a subject for another video, is can we ever get back to building enough houses to sort out that supply demand issue? So another thing to talk about. So that's anecdotally in the construction sector. Okay, let's go back over here. Production, by the way, is also not looking particularly healthy, but we are definitely being underpinned by our services. So I don't want to dive into all of this. This is just a sort of summary of everything we've got going on. So let's just recap. So we've seen Rightmove talk about a bounce up. We've seen both Halifax and Nationwide talk about a bounce up. We're seeing mortgage rates and affordability. Mortgage rates come down, affordability go up because of that. Price cap go down, affordability go up more. Inflation potentially coming down. All the indicators are looking positive in terms of property market. When you put all these things together, theoretically, there should be a bounce coming in the property market. Bank of England, and I think where we see inflation on Wednesday is going to start to give us a better idea of what's going to go on with interest rates. Bailey's tone seems to have changed, I would say, over the last few weeks. he seems to be implying that maybe that sort of up at the top and not moving down for a long time might not be the case. He seems to be saying now, because they do want to hang on to that sort of caveat, all the data is showing positive. He's saying that the global shocks are the biggest threat to the economy right now. So actually, internally, he thinks things are pretty good, or that's the narrative that he's putting out. And of course, at the moment, we've got the Red Sea. So we've got conflict in the Red Sea. We've got effectively military action that we're participating in the Red Sea. What effect is this going to have? Is that going to lead into any more escalation? We've still got Russia, Ukraine. So we've got multiple things, going on. What will be the fallout of that? And right now, we don't have a clear direction. If we look at the price of Brent, it's not going anywhere. It's not spiking. So this isn't filtering into the system. So right now, we're not seeing huge supply shocks to oil supply or anything like that would feed back into the inflation figures and push that up again. So right now, even this is looking like the inflation will continue coming down. Only other things I wanted to talk about before I go over to questions is unemployment. So we're expecting the next employment release to come out 16th, so same day as CPI. I think it'll be interesting to look at. For those of you who don't know, basically the respondents to the survey have been, the respondents survey have been so low, the data's been completely inaccurate. And the ONS have said we can't get accurate employment data from the amount of survey results getting back. So they're using experimental data. So we have to take all of this with a pinch of salt. But I did catch this that just came out today, which is talk about demand for UK labour hits lowest level in a decade. Okay, so again, this is now another leading indicator of where the economy is. And of course, that is going to have an impact on where interest rates are going as well. So we still got lots of conflicting push-pull factors, which is difficult to understand where we're going to be going. So there's a narrative of interest rates staying higher for longer. But I think we're starting to see a lot of very credible reasons for those interest rates to come down quicker than we think. And of course, the markets totally agree with that. One more thing I want to talk about. I saw this survey. I don't know if anybody else saw this today. YouGov survey, the largest in 5 years, came out that predicted the Conservatives are going to effectively have a extinction event at the next election. So they're going to be wiped out. And this is the results of the survey. And one of the biggest aspects that is at the moment on course to create this scenario is the reform vote, which is going to, rather than put more Labour people, or give more votes to Labour, it's going to take a lot of votes away from the Tories. So a lot of Tory voters are going to vote reform, which will let in Labour candidates and Lib Dem candidates in a lot of constituencies. And right now, this poll is saying a landslide for Labour with a vast majority. Whereas if the reform vote was taken out, okay, and the reform vote went to the Tories, you probably end up looking at a hung parliament situation. So there's a lot of work for the Tories to do. I'm sure they're not going to sit here and just let themselves be wiped out. So I think that the more extreme this data comes out, I think the more extreme the narrative that they're going to be pushing out as we run up to the next election. So I can't imagine we'll see anything other than tax cuts, whether or not we agree with them or whether it's the right thing to do. But with the swap rates coming down, with the the Treasury yields coming down, the gilt yields coming down, that gives them more money to play with because they're not servicing as much losses on quantitative tightening and their big debt burden. And I'd also see them trying to pull the rabbit out the hat for the property market and have some external stimulus into the property market. So effectively, I think, yes, my thoughts on this are the worse the figures are for them, the more extreme their policies are going to be as we run into the elections, try and win back some votes. But it's looking like, I said, I can't remember if it's before Christmas or in between Christmas and New Year, that the main battleground for the Tories was going to be affordability. Actually, now it looks like it's going to be immigration. And that's what the narrative seems to be, that they're focusing more on immigration. So we will see what they come up with in terms of policies. But that is not looking good for the Tories. So we'll see what they come out with at the next budget. So overview. There's a lot of data we've gone through there. My big overview is nominal house prices have not dropped nearly as much as anybody thought. People were talking, I think most conservative commentators in 2023 were talking 8 to 12% nominal drop in 2023. We didn't get it. The more extreme were saying 25, 30, even 35% in 2023. We certainly didn't get anywhere near that. What we have seen is a huge correction for the last 18 months in real house prices, which if anybody cares about what their asset is actually worth, this is a really critical piece of information. And I know it's all relative, so if you're just buying and selling home, it's not important, but understanding that property is a store of wealth, or if you're a property sort of professional entrepreneur and looking to profit from property, you need to understand that. And then when we look at the direction for the next, I don't know, let's say 3 to 6 months, it's quite difficult to call. I would say all the indicators are showing that we will get interest rate cuts quicker, unless a third-party black swan geopolitical event comes in and sends supply shock back through the system. So I think that's where we are right now. And with that in mind, let's have a look at what we've got in the comments. So, by the way, if there was anything up there that was of interest to you, please give me a thumbs up. Apologies if I was speaking too quickly at any point. I know we try and cram a lot into these live sessions, and I've had some comments about speaking too quickly. So hopefully it's all there. Right, let's look at some of the comments. So we've got Gordon. Nice to have you on, Gordon. I know it's very tenuous, but after the NSI announcement of a price draw cut from 4.65 to 4.4 at the March draw, do you think the Bank of England have tipped them the wink of an IR cut in interest rate cut in April? I know we're probably going back quite a lot in the questions from the live stream now. I would say, Gordon, it's rather than a tip the wink. I just think it's the market. The market makers are dictating swap rates, savings, swap rates, all of that sort of stuff are linked to the swap. And it's effectively how the institutions lend to each other. So if the swap rate's coming down, interest rates generically on savings accounts, mortgage accounts will all be coming down. So I think it's just an industry-wide thing. And actually, a lot of this, we have to disassociate or split where the sort of yields are in terms of like gilt yields, right, and swap rates, and the Bank of England central bank rate, because they are two separate things. And understanding that is quite critical, because mortgages, saving rates are not based on the Bank of England base rate, right? They're based on the swap rates. And things like, government lending and what they're servicing and the amount they're servicing on their debt pile is linked to yields, yield values on gilts and things like that, rather than the Bank of England base rates. They are two separate things. Don't know if that answers the question. Stafford, it was odd to see lenders drop their rate a day or so after the Bank of England had been in front, let me just put that on, been in front of the select committee and state they didn't expect to drop rates soon. Well, you can probably just look at whatever the lips are saying and go the other direction, can't you? So if they say they're not going to expect to drop rates soon, it probably means they are. But I also agree when you said lenders are getting desperate for trade. Stuart, let me put this on. The indices might show little change in HPI over the last year, but property isn't shifting. Property that should have sold in early 2023 has been sat on the market since the summer. Yes, and I think this is important point, Stuart. If we again go to, let's just go back to the Rightmove HPI. Effectively, what we're talking about is this graph here. Now, don't forget, these are averages, okay? Everything here is averages. So if you've got some at 71 days, you're going to have, some that are priced appropriately are going quicker, but a lot that are sitting on the market for a lot longer than 71 days. And this very much depends, right, on if you're motivated to sell. Now, what this shows me, by the way, is the fact, and almost perversely, I think it shows a stronger market or a stronger climate for the property market than if things were going quickly. Because if stuff is sitting on the market for a long time and it's not shifting, it means the motivation to sell is low. Because if the motivation to sell was high, then that property would be slashed in price to get it away. And by the way, that is what dictates property market changes. Is property markets crash when people need to liquidate quickly, right? People need to liquidate quickly if they are going to get repossessed, right? So the bank are coming to repossess and they want to save the equity that they've got left. Basically that's generally a lot. That's generally the main reason. people need to sell quickly to release equity. And the quicker somebody needs to sell, the more of a haircut they're going to get, right? So if you don't need to sell quickly, you can put your property on at what you want to get and just leave it there. And somebody might come over and buy it at some point, even if it's 6 months in the future or 12 months in the future. You might just get lucky and get that one. So that shows to me unmotivated sale. You need to sell quickly. You're going to have to drop your price. You drop your price, the whole market starts following suit, because then you've got your comparables. Properties are selling cheaper. If they're selling cheaper en masse, when you go and appraise a property, it's like, well, that one in that street is just sold for, let's say they've been selling for 100 grand. It's like, oh, actually, that one's just sold for 135 grand. So we're going to place it at 135 grand. Then if you need to sell quickly, you sell it at 130, and it continues down that spiral. So yeah, that's my take on it. My take on this slower market. And don't forget, we've got really low transaction volumes as well. So this has also been skewing things. So there's just no buyers out there. So the sellers who are trying to sell are not that motivated, but there's not a lot of buyers. Everybody is sitting on their hands, or have been sitting on their hands, which shows there's no forced selling regime. And forced selling regime is the biggest thing that's going to crash the property market. Now that might change. If we suddenly go into a deep recession and unemployment spikes up, okay, that could change. And all of a sudden, somebody loses their job, they can't service their mortgage anymore, they're going to have to sell, trying to get their equity out as quickly as possible to go and, support them or buy something smaller or whatever that is. Now, on this article here, demand for UK labour hits lowest in a decade, there was actually a forecast on, if I can find it, unemployment rates. Don't know. I've not got my glasses on. Apologies, team. When I don't have my glasses on, sometimes it takes a little bit longer to try and find things. It might be on there, and I just can't see it, or maybe it was on a different article I saw. It could have been on a different article. However, the forecast for unemployment, even talking about the labour market starting to unravel, was still sub 5%. Sort of peaking at sub 5%, which is still well below the historical sort of mass unemployment figures. And I know, right, before somebody picks me up on this, I know that labour figures now, and I'm a firm believer of this, by the way, and talk about this all the time, are completely different. When we look at unemployment figures now, it's completely different to looking at them in the 70s, for example, just as what is classed as an employed person. You could be self-employed, you could be on a 0 hours contract, working 1 hour a month, and you still go into that category of employed. For the unemployed, basically, if you've been looking for a job in the last 5 weeks and you're able to start a job in the next 4 weeks, you're classed as unemployed. Anything out of that bracket, you're not working, you're in the economically unproductive bracket. So it's quite difficult to compare unemployment now with unemployment, sort of 70s, 80s, when we had the last major recessions. That's an interesting fact. So it's quite difficult to look at the data and draw conclusions from where we actually are right now. Again, anecdotally, I know certainly in scaffold world, there's a lot more labour looking for jobs at the moment, which implies a softening, because of course there's no construction going on. Scaffolders aren't all out there working, or new build scaffolders. My scaffold company, we do a lot of industrial and commercial. Actually, never been busier. But the new build, some scaffolders specialise in new build scaffold sites. So with Barrett or Persimmon or whatever. And that is definitely being hit on a big scale. I don't know if anybody saw that Stuart Milne went bankrupt last week, which I thought was major news. We'll talk about that another time. So there we go. Yes, good discussion point there, Stuart. Thanks for that. What else we got? There we go. Knight Frank. I'm going to put this on. Knight Frank revised house price forecast for 2024 from -4% to +3%. Yeah, and I would not be surprised at all if we do see a pop in property prices this year because of all the things we've been talking about. Would not be surprised in the slightest. All depends. Still, it all hinges on the economy and what happens to the economy. If we escape recession, okay, and we push everything out to the right, which, by the way, escaping the recession probably is pushing everything out to the right in terms of a more cataclysmic event, I would say we will see property price rise in 2024 if we escape recession. Rig, I'll answer this one question. I've got to go because I'm onboarding a new client in about 20 minutes. If we have a mortgage offer via mortgage advisor, can we call lender directly to change mortgage rate or via advisor only? Rig, if you've got a mortgage offer through an advisor, work through your advisor. Don't your relationship is with the advisor. They'll have a relationship with the bank. Speak to the advisor. That's what you pay them to do, is to have those discussions. They've got the relationships on the other side. So just let them do their job and go and find fine stuff. The only caveat to that is this, of course, you're working with a bank directly. So if you're sort of like I work with Lloyds directly with my portfolio, I just go directly to them because I don't have a broker or an advisor in between me. But yeah, I would say go through your advisor. That's what you pay them to do, and they'll be able to get the best rates for you. Lovely. All right, team. Been a pleasure as always. So I just wanted to do that sort of recap because I know I've been away for the last sort of 5 days or so. Get that out there. Wednesday, we've got inflation data coming out, and we'll be looking to go live on Wednesday and crunch those numbers probably sort of Wednesday afternoonish. Yeah, looking forward to seeing what happens with that one. But otherwise, have a good couple of days. Good start to the week. And I'll see you on Wednesday.